Today, July 31, 2025, the global economy, financial markets, and geopolitical landscape are all under significant pressure as a series of high-impact events unfold. This is one of those days when headlines across the world are connected, each one feeding into broader market sentiment, investor psychology, and political calculations. 1. U.S. tariff policy, a new front in global trade. The United States continues its aggressive tariff campaign under President Donald Trump. Overnight, Trump officially signed a new trade agreement with South Korea, one of America's top 10 trading partners and key allies in Asia. This agreement establishes a 15% tariff on imports from South Korea, down from the previously threatened 25%. While this reduction offers some relief to Seoul, the new tariffs are still a major cost burden for Korean exporters. The deal also includes a package of commitments from the South Korean government and corporations to invest over $350 billion in the American economy over the next several years. Additionally, South Korea has pledged to purchase at least $100 billion of U.S. energy products, including liquefied natural gas and oil. Markets and political observers see this as a calculated compromise. The U.S. gains immediate tariff revenue and long-term investment pledges, while South Korea avoids even harsher tariffs. Yet tensions remain high. Korean officials have privately expressed concern that this could be just the beginning of a series of new trade demands from Washington. But the story does not end there. The Trump administration has also introduced 25% tariffs on imports from Brazil and India, two of the world's largest emerging markets. India, in particular, faces the risk of additional penalty measures because of its close trade and energy ties with Russia. Washington has made it clear that New Delhi must choose between deepening its relationship with Moscow and maintaining favorable access to the U.S. market. These moves come just weeks after the White House removed the de minimis exemption for low-value packages, a rule that previously allowed small international shipments to enter the U.S. duty-free. This change is expected to significantly increase costs for e-commerce companies and consumers who import goods from overseas marketplaces. The tariff blitz does not stop there. In a dramatic escalation, the administration has imposed a sweeping 50% tariff on copper products such as pipes and wires. While raw copper itself was excluded from the measure, the news triggered a sharp reaction in commodity markets. Copper prices plunged more than 17% as traders recalibrated expectations for demand, supply chains, and inventories. The cumulative impact of these tariffs is still being assessed, but analysts are warning of ripple effects across global manufacturing, energy, and consumer goods. Higher input costs, disrupted supply chains, and retaliatory measures from U.S. trading partners could all slow economic growth in the second half of the year. 2. The Federal Reserve holds rates. Markets brace for a longer pause. Amid these trade developments, the U.S. Federal Reserve delivered its latest monetary policy decision. The central bank kept the benchmark interest rate unchanged at a range of 4.25% to 4.50%, a level that many economists already view as restrictive. The vote was 9-2, with 2 dissenting members, both appointed by President Trump, calling for an immediate rate cut. However, Fed Chair Jerome Powell and the majority of the committee argued that inflation pressures, while moderating, are still too high to justify easing policy. In his press conference, Powell struck a cautious tone, saying it is too early to expect a rate cut in September. This statement dampened investor hopes for a rapid pivot to lower borrowing costs. Markets reacted quickly. Treasury yields rose, reflecting expectations that interest rates will stay higher for longer. The US dollar strengthened against most major currencies, adding further pressure on emerging markets and commodity prices. Equity markets, meanwhile, showed a more nuanced response. 3. Market reactions, a mixed but resilient picture. Despite the uncertainty, futures for the S&P 500 and Nasdaq rose modestly. The gains were largely fueled by strong corporate earnings from major technology companies. Microsoft delivered a standout quarter, surpassing Wall Street expectations for both revenue and profit. The company's cloud division, Azure, reported annual revenues exceeding $75 billion, cementing Microsoft's position as one of the leaders in artificial intelligence and enterprise computing. Microsoft's market capitalization officially crossed the $4 trillion threshold, making it the second company in history to achieve this milestone after Nvidia. Meta Platforms also impressed investors. The company posted double-digit profit growth and unveiled ambitious plans for AI infrastructure and its so-called superintelligence initiative. Meta's shares surged 10% in after-hours trading, adding hundreds of billions of dollars in market value. Other tech giants, including Apple and Amazon, are scheduled to report earnings later today. These results will be closely watched for clues about consumer spending, supply chain dynamics, and the broader trajectory of the global economy. In Asia and the Middle East, markets moved mostly sideways. Investors in these regions remain wary of global uncertainty, particularly around US tariffs and potential retaliation from affected countries. Corporate earnings across several Asian economies have also come in weaker than expected, adding to the cautious mood. Emerging markets are facing additional headwinds from the stronger US dollar. When the dollar rises, it increases the burden of dollar-denominated debt in developing countries and can trigger capital outflows. Several analysts have warned that this dynamic could amplify financial vulnerabilities in countries already grappling with slower growth and higher inflation. 4. Central banks abroad, fighting inflation and supporting currencies. Regional central banks are also active this week. The Reserve Bank of India, RBI, announced an emergency liquidity absorbing operation worth 500 billion rupees, or roughly $6 billion US. The move, known as a variable rate reverse repo auction, is designed to mop up excess liquidity in the banking system and help control inflation. The Bank of Japan, BOJ, meanwhile, left its benchmark interest rate unchanged at 0.5%. BOJ Governor Kazuo Ueda expressed cautious optimism about Japan's economic recovery, but acknowledged the challenges posed by a persistently weak yen. Markets are now watching for any signals that the BOJ might adjust its yield curve control policy later this year. 5. The next 72 hours. A crucial window. The next 3 days are shaping up to be one of the most important periods of the year for global markets. On the monetary policy front, the Bank of Canada will announce its own interest rate decision. Like the Fed, Canadian policymakers are balancing inflation risks against signs of slowing growth. Corporate earnings will also dominate the headlines. Apple and Amazon are expected to provide detailed guidance on consumer demand, supply chain resilience, and their investments in artificial intelligence. These reports could set the tone for the entire technology sector for the remainder of the year. Finally, the deadline for the implementation of new US tariffs is just hours away. If no last-minute changes are made, the tariffs on Brazil, India, and copper products will take effect on August 1st. The prospect of retaliatory measures from these countries is already weighing on market sentiment. 6. Broader geopolitical context. Beyond economics, geopolitical tensions are adding to global uncertainty. The US recently unveiled new sanctions on an Iranian oil trading network, aiming to cut off a critical source of revenue for Tehran. Canada and several other G7 countries have also moved to formally recognize the State of Palestine, a decision that they say is necessary to preserve the possibility of a two-state solution to the Israeli-Palestinian conflict. In East Asia, US-China trade talks are tentatively progressing, but the risk of a breakdown remains. Any failure in these negotiations could trigger a new round of tariffs and counter-tariffs, with potentially severe consequences for the global economy. Meanwhile, Europe is grappling with its own challenges. Germany faces a €170 billion budget deficit, forcing the government to consider deep cuts in areas other than infrastructure and defense. Italy's economy unexpectedly contracted in the second quarter, highlighting the fragility of the Eurozone's recovery. 7. Commodities and energy. Volatility returns. Commodity markets are highly volatile. The plunge in copper prices following the US tariff announcement has created ripple effects in mining stocks and industrial supply chains. Oil prices, meanwhile, are fluctuating as traders weigh concerns about global demand against potential supply disruptions. The new US-South Korea deal is expected to increase American energy exports, which could reshape trade flows in Asia. Natural gas markets are also in focus as Europe prepares for the upcoming winter. Storage levels are relatively high, but geopolitical risks could quickly change the outlook. 8. What it means for businesses and consumers. For businesses, the combination of tariffs, higher borrowing costs, and currency volatility is creating a challenging environment. Companies that rely on global supply chains face rising costs and unpredictable delivery schedules. Those with significant exposure to emerging markets must navigate additional financial risks. For consumers, the impact will be felt through higher prices on imported goods, from electronics and appliances to clothing and household essentials. While some companies may absorb part of these costs, others are likely to pass them on to customers. 9. Key questions going forward. As we look ahead, several key questions remain unanswered. Will US trading partners retaliate against the latest round of tariffs? And if so, how severe will the countermeasures be? How long can the Federal Reserve and other central banks maintain high interest rates without triggering a deeper economic slowdown? Can emerging markets withstand the pressure of a stronger US dollar and potential capital flight? Will the earnings momentum from major technology companies be enough to support equity markets in the face of mounting macroeconomic headwinds? 10. Final thoughts. The world is entering a period of heightened uncertainty. Trade tensions, monetary policy decisions, and geopolitical risks are all converging at the same time. Investors, businesses, and consumers alike will need to stay informed and flexible as events unfold. The coming days could set the tone for the remainder of 2025 and potentially beyond. If you found this analysis valuable, please subscribe to the channel to stay updated on the most important news and trends shaping the global economy and financial markets. Like this video, share it with friends, and leave a comment with your perspective on today's developments. Disclaimer: this information is for educational and informational purposes only and does not constitute financial advice or an investment recommendation. Always conduct your own research or consult a licensed financial professional before making any investment decisions.